Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to see what is really going on under the hood. Today we are looking at N2OFF Incorporated and a very interesting little report they recently put out. Get ready because we are diving into some unregistered stock sales and what that might mean for the company and its investors. Make sure you are subscribed for more of these deep dives, and if you want to chat with us and a community of fellow corporate watchers, join our Discord linked in the description below. We usually dive straight into the financials, but this filing is a bit different. It is focused on a specific event and unregistered sale of equity securities. Essentially, N2OFF Incorporated, a company that is registered in Nevada, put out a report about selling some of its stock. This happened on the 8th of January 2026. The company handed over 35,000 shares of its common stock. Now, who got these shares and why? They were given to a consultant. This consultant was hired to provide investor relations services. Think of it as paying for help to get the word out about the company and attract investors. This is the really juicy part. These shares were not sold on the open market like you might buy stock on the Nasdaq. Instead, they were given out under what is called an exemption from registration. This means they were considered a private transaction, not a public sale. The Securities and Exchange Commission, or CAAC, allows this for certain deals, especially when it involves private placements or deals with a limited number of sophisticated investors or service providers. The company is claiming they didn't need to go through the full registration process because it wasn't a public offering. So, what does this mean for us watching from the outside? When a company issues stock without registering it publicly, it is often a sign that they are trying to keep things quiet or that they are dealing with specific needs. In this case, they paid for services with stock. This can be a way to conserve cash, especially for smaller companies. However, it also means that these 35,000 shares are now out there with a party that isn't necessarily a long-term investor in the traditional sense. They might sell these shares soon after receiving them, which could put downward pressure on the stock price. Let's look at some of the other details here that give us a bigger picture of N2OFF Inc. The company itself is called N2OFF Incorporated. It is incorporated in Nevada, and its commission file number is 001-40403, and its IRS employer identification number is 26 to 4,684,680. Interestingly, its principal executive offices are located in Israel. This might suggest a global operation or a specific strategic location for its operations. N2OFF Incorporated has common stock with a par value of $0.0001. Par value is a nominal value assigned to stock and usually has little bearing on its market price. The trading symbol for this common stock is NITO, and it is traded on the Nasdaq Capital Market, LLC. The filing also indicates that N2OFF Inc. is an emerging growth company. This status means they are allowed certain regulatory flexibility and can use extended transition periods for new accounting standards. This often points to a younger company still finding its footing in the public markets. This report is filed with the Securities and Exchange Commission, or SEC, which is the main government agency responsible for regulating the securities industry in the United States. This particular filing is a Form 8K, which is used to announce major corporate events that shareholders should know about. In this case, the issuance of unregistered stock is considered a material event. Now, looking at this report, the main story is about how N2OFF Inc. is choosing to compensate its consultants. By issuing unregistered shares, they are essentially trading ownership stakes for services. This is a common practice for early stage companies or those looking to manage their cash flow carefully. What's the takeaway here? N2OFF Inc. is a relatively new public company identified as an emerging growth company with operations potentially based outside the US. They are actively using equity to pay for services. Specifically investor relations, while this can be a smart move to preserve cash, it also introduces a variable for existing shareholders. The consultant receiving these shares might decide to sell them in the open market, potentially impacting the stock's value. Investors should keep a close eye on any significant sales by this consultant and monitor the company's cash position and overall growth strategy. There are no major financial tables in this particular 8K, so we can't do a deep dive into revenue or profit. However, the core message here is about how the company is managed and how it is growing its team and services, using its own stock as currency. So, to wrap up, N2OFF Inc. is issuing stock privately to pay for investor relations services. This isn't necessarily a red flag, but it is something to be aware of. It suggests a focus on growth and potentially a need to conserve cash. The fact that they are an emerging growth company gives them some leeway, but it also means they are likely still building a solid track record. What is your take on companies using stock to pay for services? Do you see it as a sign of financial discipline or a potential early warning? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth corporate analysis, and don't forget to join our Discord community for more discussions. Thanks for watching, and we'll see you in the next one.